Welcome. My name is Cole Evans. I am the Portfolio Relationship Manager here at AccuVest Global Advisors. AccuVest Global Advisors is a registered investment advisor with the SEC, and this is our first live recorded episode of the Market Mosaic. I'm here with Eric Clark, our Chief Investment Officer. Eric, thanks for doing this with me today.
What's up, Cole? I want to know where you are. You in Palm Springs? That's the background. That's what it looks like. I like it.
I wish, if only. I am here in beautiful Provo, Utah. Excited to be doing this podcast with you. We're just going to talk markets, talk about what we're seeing. This podcast is not only for our clients, but also for investors around the globe. I feel like that's one of our specialties here as a global family office. But set the scene for us. Markets are near record highs. It's been a choppy, nervous year getting here. When you step back, what kind of market are we actually in right now?
Yeah, we're in a schizophrenic market, really. But before we even get into it, let's just, as a reminder, this is not financial advice. This is us just having a conversation about markets for illustrative and educational purposes only. And everybody's got to kind of do their own research. So I just want to make that very clear. Listen, from a market perspective, it's been a wild ride, and akin to let's call it a roller coaster. And what I mean by that is just to throw out, in the first quarter, tech was down 11, and tech's obviously the biggest sector in the index. Tech was down 11, the S&P was down 7, and just a low vol defensive dividend was up 12. So that'll tell you what the first quarter was like. And then that obviously came because of the announcement of the Iran war and the actions over in Middle East. And we had a little bit of an oil spike and all those kinds of things. A little nervousness about inflation. And then in Q2, we had the reverse. And the rubber band got really stretched by the end of Q1. And when rubber bands stretch, if when you let go, it stretches back the other direction, almost with some similar symmetry. And so for the second quarter ending in June, the S&P was up 14, tech was up 40, right? Semiconductors up 65. DRAM memory stocks, which was the hottest part of the tech and AI trade, the DRAM ETF was up 166%.
Wow.
So in 6 months, you had some, wild volatility, which, chases some people out, makes people, use emotions. And so we just have to, one of the things that we talk about with clients all the time now is that whether we like it or not, volatility is here to stay. And it is now not a bug, it is a feature of the market. And you just have to understand that the price of admission to get decent equity returns, or at least the hope of decent equity returns, is that you need to absorb volatility along the way. And in part, and this is not a political statement, in part because we have someone in the White House who's directing policy who likes to be in the news every single day, right? If the market is driven by algorithms, and algorithms use short-term momentum signals and headlines as some of their signaling and decision making, then naturally, if you have somebody who wants to be in the news every day, algorithms are going to go wild sometimes. And so that, it's not what we would like. And the old adage, you got to trade the market you have, not the one you want, is really kind of in play all the time these days. And to add to that, in July, I just told you the tech sector was up 40 plus. And different parts of the tech sector were up even more. There is a massive momentum trade that was very crowded, very extended, and all it needs is one little light of a match to make that momentum crash when it gets so extended. So for the month of July, you had semiconductors down 17, DRAM, the memory down 31, tech down 8. There was a lot of volatility strictly in the month of July, and the S&P was flat, so it wasn't everywhere. So that tells you that diversification, even though it hasn't worked near term over the last 12 months because the market has been very focused on one thing, the tech and the AI, diversification really needs to be there from a prudent fiduciary perspective, but it also needs to be there to help you in those kind of periods, because the S&P was flat at a time when the crowded trade really unwound pretty violently. And then to add even more, to August, the S&P's up 3, tech's up 6 after, a big down move. The memory stocks are up 7, and semiconductors are up 5, and it's only 6 days, the 6 days of August. So you have had a massive volatility rip to the upside. Those feel good. Then you had a crash, and then you had somewhat of a recovery, all in a short period of time. And that scares our clients. It scares investors in general. And we just have to understand that the market has become a casino driven by options markets, 0 days to expiration options, double and triple levered ETFs. I don't love all that stuff, but it is what it is. So we have to navigate on behalf of clients of, what kind of market do we think we're going to have? What are the macro markets saying? What are the economics saying? What is the corporate earnings saying? And then try to just navigate through the volatility whenever it arrives.
Yeah, and I think you just kind of touched on it there, but that roller coaster and volatility like this, where it's so unpredictable for a CIO, must be difficult managing so many different strategies, portfolios. Same for everyday investors. As a CIO, how do you specifically manage that volatility and look at it and not get discouraged with this kind of roller coaster ride we seem to be on?
Well, it's hard not to get discouraged because you see volatility, and it doesn't affect me personally as much because I can absorb a lot of volatility, right? I've been doing this 32 years. I used to trade for a living. If you're a trader, you absolutely have to learn how to deal with volatility and usually make it an advantage. Doesn't always work, but for long-term focused investors, it can shake your faith. And so, one, we have to reiterate what it is that we do for clients. And, one of our North Stars that we always talk about is every advisor, every portfolio is anchored by something. There has to be some belief system. Otherwise, you're just chasing the new cheese of the day, right? So we're anchored to quality, companies that are high quality in nature. We're anchored to the consumption theme, through our logo ETF in particular, and some of the other brand strategies. Why? Well, if the global economy is about 120 trillion and 60% of that is consumption, that's consumer spending money, government spending money, businesses spending money. Well, that's the largest theme driving every economy on planet Earth. So I don't know how you could or should want to, not have some dedication to that theme of consumption, just given how large and chronic and persistent it is. Then we're anchored to thematics because there are certain things that are happening in the world that you might want to anchor to, at least in part to your portfolio. Not necessarily put all your money in there, but tech and AI is a strong theme. It's just beginning. It just started with ChatGPT in 2022. So if you think about it, it feels like AI has been around a long time. It really hasn't. You know, the globe's population of 8 billion people is aging. People that are older have a lot of money. There's some wealth management in that theme. There's some aging of society in that theme. There's biotech and innovation that's tied to AI in that theme of aging. There's an industrial renaissance happening because of reshoring and nearshoring, and we play that through our thematic basket. So, quality, consumption, thematics, and then, just trying to manage risk along the way for clients, understanding that the business cycle will always matter. And there's good parts of the business cycle. There's not so good parts of the business cycle. Recessions tend to happen. Certain things need to be done in a portfolio when your data suggests that a recession is much more likely. So, that's our kind of North Star. And within volatility, you just have to learn, kind of retrain your brain. What is mechanical volatility and doesn't matter to the fundamentals, and what is real important volatility to listen to, and how might you change your portfolio because something's happened, whether it's a pandemic, it's a war in the Middle East, an internet bubble bursting, any number of things could be happening, but you need to be, you just need to be mindful of what it is that's causing the volatility, and should you ignore it because it's mechanical and options related, or is it, something you need to pay attention to? Because the last North Star really is corporate earnings are really what drives the stock market, right? If
Mhm.
earnings generally are going to fall, the equity market's going to struggle. If earnings are generally good and the earnings are going in the right direction, then stocks in general should perform pretty well. And just to level set expectations, it's been really good for the last 15 years, right? A long story, over the long period of time, equities tend to do about 10%. Let's just use that as a baseline. Sometimes more, sometimes less. Oddly, very rarely do they do the actual 10%. It's either less than that or more than that generally. The last 15 years, it's like been 14, 15% for the S&P 500. So right now, as we talk, it's August 6th after the market closed. We are 50% or more ahead of the long-term average for equities at a time when we're in the 90th percentile of valuations. Now, that doesn't mean anything because that can go on for as long as it can go on, but it does let you understand that it's been the best of times for a variety of reasons, but we are in a part of the market where valuations are pretty stretched for the average company. There is definitely some opportunities in different sectors that have largely underperformed, but that's a decent starting point for investors today.
Yeah. And you mentioned the two different kinds of volatility, the mechanical and the functional. For an everyday investor, somebody who, I don't know, is just investing in their 401k or maybe trade stocks here and there, how can they discern the difference between the two when they're seeing this volatility in the market? Are there things that your everyday investor can be on the lookout for or listening for when they tune into podcasts like ours or log
Yeah,
into CNBC?
I mean, it's a great question. It depends on how engaged somebody is. I mean, let's face it, since the pandemic, really, when governments force you to stay at home and give you money, that's really when Robinhood's business in particular really started to take off, because you had a whole new investor class, older and younger, saying, well, I'm bored. The market's open. I can't go to the mall. I can't go on vacation. Maybe I should trade and gamble and, that kind of thing. And so, what everybody needs to understand is you really need to decide who you are. And you can be both, right? If you're a younger person or an older person, you're investing for a goal. And sometimes that's a time goal, or sometimes that's for your kids' college education. Sometimes it's for retirement, whatever it is. And sometimes you can do short-term things. Like trading has become a lot more popular. The gamification of markets has become very popular. And short-term thinkers are very different than long-term thinkers, right? I'm a long-term thinker because I'm putting my money away for the next decade or so, and I just want it to compound over time and let time be my ally. Short term, you see this wild volatility. There's either a lot of news happening that's causing that, or options markets, short-term positioning is driving some of these things. And like I said, the 0 days to expiration, imagine what kind of volatility you can have if people are making bets on what's going to happen by tomorrow or by Friday, right? You got to nail the timing right. And so, if you look at a name that you own or an ETF that you own in a certain sector, and you see some wild volatility in that name, but you don't see any news. There's no, X stock is up 12% today or down 14% today, and they didn't report earnings, and there's no headlines, yet the stock's wildly up or down. That's when it's part of it. It could be part of a sector or a style factor basket, meaning characteristics, growth, value, momentum, and that has nothing to do with the company. It just software stocks went straight down, semiconductor stocks went straight up because of AI, but you could have had software companies that are performing really well as businesses. The market doesn't care because it's a big part of the software ETF that's getting shorted by hedge funds and algorithms, right?
Mm,
You're getting volatility that has nothing to do with the thing that you own, and it's strictly based on factor baskets and hedge fund trading and algorithms. So, you know, you just have to look and say, well, I don't see any news, therefore I shouldn't worry too much. And if you have extra money, maybe if the thesis hasn't changed, you should endeavor to buy more of it and take advantage of that mechanical volatility when you feel pretty good that the fundamentals of the business hasn't changed at all, and yet the market's put it on a 10% sale.
love when you can get a quality stock or ETF for cheap.
Diamonds in the dumpster.
Well,
There's nothing wrong with that, right?
yes. Once somebody figures out what kind of investor they are, I feel growing up, and a lot of people might relate to this. You were always told, I mean, the classic advice forever has been 60% stocks, 40% bonds, or based on your age, that should be your allocation to bonds. Is that still the right starting point, or has the world changed? Our markets a little different than they were?
Yeah, I mean, you have to remember why the 60/40 theme was created. It was created decades and decades ago, and what was really prevalent, um, bonds in particular, interest rates fell for like 40 years for the most part, right? And what that meant is that the bond allocation was inversely correlated generally to your equities, meaning if equities were down, your bonds were the place that was really making your portfolio more stable. And that was valuable, right? So you didn't have to be fully invested in equities because, bonds were giving you a coupon or income, plus interest rates were falling, which helps bond prices rise. So you were getting a 7% return in your bond allocation, and it was protecting you when equities were struggling, and equities were giving you that normal 10%. So you got a pretty good return with a lot less volatility. Well, 40 years, interest rates finally bottomed at zero, basically. The Fed went on zero interest rate policy, and you didn't end up getting much return in your bond allocation, and that forced people out the risk curve and forced them to think, well, how am I going to replace that, that return series? So, at least fast forward a few years, you're at least getting, 4% or so, depends on the bond asset class, but you're at least getting 4% on the coupon, the income, but you're getting more volatility than you ever have in your bond allocation because of inflation, and you're getting, you know, you're not getting that total return, and you're getting more volatility, and you're not even getting all the time an inverse correlation. So look at 2022. Interest rates went from 0 to 5.25. Inflation went from 2 to 9 because of the pandemic. Your bonds were horrible, your equities were horrible. And at least people think, hey, I know the price of admission for equities is sometimes my portfolio is going to look terrible. You don't think that way about your bond allocation. People always think, hey, my bonds are kind of there to protect me. They're kind of sleepy. And when equities are getting destroyed, that's going to be the place that's going to make me feel good. Well, bonds were terrible too because interest rates went straight up. So, when I think of 60/40, I just don't think it's the same 60/40 that it used to be. And
Yeah.
it doesn't mean that bonds don't have a place for people. And I always, when we're talking with clients, we want to know, do you want or need current income?
Mm.
Bonds really do serve you well for current, particularly monthly income. If you do, bonds are a good thing to have. And we can talk about different asset classes that make sense. But if you don't need income, and you're older and you just want less equities because you don't like all this volatility, bonds also serve that master pretty well, right? Your bond allocation is a 4 in a risk. If you think about risk at 10, it's very risky. At 6, it's kind of your 60/40 risk. Your pure bond allocation is like a 2 to 4. There's value in that if you are the kind of investor that skews, I want an okay return. I want good downside protection and I don't want a lot of volatility, bonds are really good for you. So, what you have in the 40 part of your 60/40 really should depend on your age and your time horizon and your need for income and how much volatility you're willing to withstand. I kind of think of 60/40 not as a static 60/40. I think of there are certain times, and I'll use an analogy when you're driving down a highway. Take your 5-lane highway, the five here, or I live in San Diego, so I'm going to use the 5 as an example. In the very early morning, there's not a lot of traffic. You can probably go faster and be safe because not as many people are on the road, right? Let's take that analogy for equities and bonds. In that regard, that's the Goldilocks scenario for the economy. The economy's doing well, corporate America's doing pretty well, inflation's pretty tame, there's no wars. That's a pretty good risk environment. Let's call it Goldilocks to take more risk in equities. And maybe you don't need as much fixed income. Now, when you get around rush hour, that's a different story. Traffic slows down, a lot of people come on, people are paying attention to different things. You might have had a bad day at work. That tells you maybe you should slow down a little bit when you get on the highway, right?
Yeah.
Turn to the 60/40 analogy. Maybe the bond allocation gets more valuable. So at certain points in the business cycle, maybe your risk tolerance and your goals plus the risk-taking environment might warrant you taking 80% in equity risk and only 20% in fixed income. At other times, rush hour, aka maybe there's a higher probability of a recession. Maybe the Fed isn't really your friend because they're raising interest rates. Maybe that 60% equity should be 40, right? I just kind of think of it as, you can do 60/40, or you can say, let's add one factor into this, your investor profile. What's the risk-taking environment? And then maybe we start at 60/40 and we ratchet up or ratchet down your bond and your equity allocation according to the risk-taking environment. That's just another way to think about it.
That's awesome. Thanks for explaining that. Just last one, as we're running out on time here, Eric. If someone takes just one thing away from this conversation, what do you hope it is?
I think whether we like it or not, we really do need to accept that volatility is here to stay. And it's not every day, right? It's just if you enter investing with a mindset that, one, your baseline return is X, two, there's just going to be volatility, and don't let it swing your emotions wildly in those directions because it's going to knock you off course, right? When you start seeing this volatility, you're going to naturally question what you're doing, and if you question it, some percentage of the time you're going to deviate from that plan. And if your plan is 10 or 15 or 20 years down the road, you don't want to deviate from your plan, right? So if you're going to take one thing away, expect volatility. It's here to stay. Understand that markets historically, listen, the price of admission for a 10 to 12% return in equities over the long term has been, you have at least one drawdown of 10% every year. The average is actually 14% peak to trough. Doesn't happen every year, but that just tells you that the price of admission for growing at a 10 to 15% rate, whatever that is for equities long term, is going to be, you're going to question what you're doing at least once a year and maybe more. It just depends on what's happening. And as long as you set the right allocation based on your investor profile and you're paying attention to the macro risk-taking environment and you're not letting volatility kind of whipsaw you on an emotional roller coaster ride, you will have you'll have a much better experience. You'll start to train your brain to take advantage of those volatile periods, those down periods, to add maybe more if you have some savings, and that's just going to help speed the time to your ultimate goal with your ultimate return goal.
Well, Eric, thank you for joining me today, and for all of you out there listening, we appreciate you spending the time with us. And this has been the first live recorded episode of the Market Mosaic. We hope you enjoyed it, and we will talk to you soon.
Absolutely. Thanks, Cole. And, if you want to get a hold of us, you can go to accuvest.com. There's a place that you can, I think there's a phone number, there's an email address. We're certainly happy to talk to you. If you're a client, we're always interested in talking to you. And certainly if you're a potential investor and you're looking for a new advisory relationship, we are always happy to chat with you on that as well. Appreciate it, Cole.
Perfect. Thank you, Eric.
AccuVest Global Advisors is an investment advisor registered with the U.S. Securities and Exchange Commission. Registration does not imply any particular level of skill or training. This episode is for informational and educational purposes only. It is not investment, legal, or tax advice, and it is not a recommendation to buy or sell any security. The views expressed are our opinions as of the recording date and are subject to change. Securities or funds mentioned may be held in client accounts or in funds that AccuVest manages and is compensated to manage. You should not assume any investment discussed was or will be profitable. Past performance is no guarantee of future results. All investing involves risk, including the possible loss of principal. Full disclosures are available in the episode description.